Welcome to a new issue of the Indicator Spotlight. About once a month, we feature a indicator from our NinjaTrader 8 library. Short little video about 10 minutes here today with a brief explanation of the main indicator concept, the most important functions, and how you can use this in a trading setup along with a download link to the indicator that we're talking about. And this time around, it's the Donchian Channel, originally developed by Richard Donchian. This is a trend-following indicator and was famously used by the turtle traders in their system. The story about the turtle traders originated from a discussion between the famous commodities trader Richard Dennis and his longtime friend Bill Eckert on whether great traders are born or made. Eckert was convinced that a certain trader type or trader character was the determining factor, whereas Dennis thought that this was really a skill that could be taught. And in order to find out, they advertised for trading apprentices and trained a group of 23 people with no trading experience. The group learned the rules of a simple trend following system over the course of 2 weeks. And when they demonstrated that they could follow the rules, participants were funded between 250,000 and 2 million, trading a range of commodities, currencies, and bond markets. And when the experiment ended 5 years later, the turtles had reportedly returned a profit of 175 million, making it the most famous experiment in trading history. So the approach was entering the market when prices broke out of the Donchian Channel in two separate time frames. So what we see here is system 1, which looked for a breakout from the 20-day high or low, whereas system 2 used a 55-day high-low breakout. For system 1, a signal would be skipped if the previous trade was profitable, whereas all signals of system 2 would be followed. The version that we're offering here from the library also allows for calculating the channel lines by using the open, close, median, typical, or weighted price. And so what we see here is the traditional definition. So it's taking the high or the low breakout. And this is crude oil here, daily chart. See a failed breakout towards the upside here, and then a short breakout runaway trade here to the downside. This is a slightly shorter time frame for our chart of the Nasdaq using a 55-bar lookback. The green plot here indicates that the highest high of the lookback period has been broken, whereas the red plot here indicates a break of the lowest low. And the neutral trend here occurs when you're retracing back above the channel midline, and you then get this yellow plot for the neutral trend. Our indicator also comes with a fast, slow, and composite trend definition. This here is the fast channel, what we're seeing here, and that allows the trend definition to trigger a few bars earlier. So we see here the long trend is triggering at the breakout of the fast channel here. Of course, the main idea here is not to predict price movements, but simply to follow them. So the turtles applied pretty strict rules for positioning sizing and scaling into trades as well. Important part of their trading system. No single trade would risk more than 2% of the available capital. And initially, only a fractional amount of the intended position size would be committed. And only if the position moved in their favor, they'd add to it. So we could imagine here scaling in here with a fractional amount here at the fast breakout, and then adding at the 55 here. That would be a variation of this concept. The obvious benefits to scaling into position is that on false breakouts, the position will be relatively small because the full position size has not been committed. On the other hand, if the breakout is strong, the maximum position size will be reached in order to fully capitalize on the winning trades. As far as exits, they were said to be the most challenging part of these rules. Same chart as before here, 55 bar high low entry definition, and exit was then the 20 bar low for a long position. This is what we're seeing here, this gray line, and the 20 bar high for a short position. For system 1, the exit condition would be the break of the 10 bar high low. Of course, waiting for this 10 or 20 bar new higher low often meant giving back significant profits, and there was a strong tendency to want to take exits earlier on. But in order for this system to work, it was necessary to stay in the positions waiting for the really big move here. Following the famous experiment, there was a significant drop in performance for this system. Richard Dennis continued to manage capital, but stopped doing so following heavy losses in the Black Monday stock market crash of 1987 and then later in 1988. He also managed funds for some time in the mid and late 1990s, closing these operations after losses in the summer of 2000. Still, a number of turtle traders continued their careers as successful commodity trading managers using similar but not identical techniques to the original turtle system. I've included a link to the original rules below here in the post taught by Richard Dennis. So I'd recommend you take a look at those, especially for calculating the position size and how to scale into the trades. All right, so the free download for this month's newsletter is the Donchian Channel. In total, we have some 125 indicators here, all available for 150 bucks. That's for all of the indicators, not for each and every one of them. And this is a one-time flat membership fee. All right, so with that, I'm going to wrap up this indicator spotlight. Appreciate you taking the time and tuning in. Feel free to leave me a comment on the video below here to give me some feedback, a thumbs up, or pass it on to a trading buddy on Facebook, Twitter, or via email. Thanks again for checking in. Have a great week coming up here, and I look forward to hearing from you sometime soon.